Financial markets are all about education and experience. Talking to industry professionals can therefore enrich everyone's journey to become financially literate, which is one of the core goals of Investro. Hello and welcome again to another episode of the Investro podcast. We are fortunate enough today to have the renowned trader and best-selling author with us, the CEO and founder of Bear Bull Traders, of course, Andrew Aziz. Andrew, thank you very much for coming on.
Thank you for having me, and hello to your listeners.
First of all, Andrew, I guess what we want to ask is maybe you could introduce yourself just a little bit more and tell us about your sort of journey into trading.
Yeah, so I started trading about, I think it was about 9 years ago when I came out of school and I had a little bit of saving. I think it was about 2013 and 14. And that time, market was becoming more and more accessible to normal people, normal retail traders. Before that, the market was there, but there was a lot of tools that were not available at a reasonable price for normal people, the main street people, retail traders. And that was the time that the market was slowly going up, and the technology was becoming cheaper and become more available for traders, normal traders. I started trading, and then I lost my job. I got laid off in 2014, and that was a really good opportunity for me to start messing around with the stock market and try to learn trading. And I got really, really hooked up really fast on that. And, I was fascinated by the concept of trading, especially day trading, active trading, that you have to time the market in a matter of seconds and minutes. And I was really, really excited. And that, turned out to be, very, new passion for me. I couldn't obviously make any money in the first year, and then I had to get another job and to support my obviously day-to-day bill and payment. And I kept my job for another 3 years while I was trading. And after a certain period of time, I realized that day trading is going well, and I have really success on that, and I really quit my day job. So I started as a part-time, and I stayed part-time for a couple of years, and I eventually became a full-time trader. I do have a couple of publications because when I was learning trading, I realized that there's not a lot of handbook, basic, step-by-step good trading. There's a lot of information out there on YouTube and the website. There's a lot of information out there, but I found that there is not a very short but very, very nice course on all of step-by-step of day trading. I decided to write a book, and I wrote the first book, and the first book became very, very successful because it was just in the perfect time, in a perfect moment, and it was the right amount of information that people were looking for, and turned out to be a successful book. And then later we published over the years more advanced books and about the psychology of trading as well. And here we go. So I'm trading every single day. I just finished trading right now before coming to the studio. And we are excited to run that. We also have a lot of educational content that we publish online for free. And people who are interested, they just share the information with people.
That was what I was going to ask you. Yeah, thank you for all of that introduction. That was absolutely great. I was just wondering, when did Bear Bull Traders actually start, and what's its mission?
Yeah. So when I published my book, I put my email address in the book. I had a blog in that time, and I was writing about trading, my trading journey. That what I did trade, how much money I lost, how much money I gained, that kind of thing. And then as book started selling and people from all around the world reading it, they started emailing me the questions that, hey, what do you think about that? Thank you for this. Or, what did you mean by this section? And I received a lot of emails, and, I realized that there is a potential for a community to be around, to come here like an online forum or some area that people can interact with each other. That's why we decided in 2015, early 2016, to start Bear Bull Traders as an online community for traders who are interested in trading, especially the U.S. public equity market. Over the years, we've grown our services, so we have essentially education that developed by all the members and community traders, especially the experienced traders. We have live stream and online chat during the market open that people ask questions and stay in touch. And it has been very, very, very the community knowledge have been very powerful. Like if you have a question, for example, about something in trading, it might take you a day or two to figure it out. Like, how do I do this hotkey, or how do I change this order, or what's the meaning of this call option, something like that. It might take you a day to figure it out, but when you are part of a community, you ask a question, and maybe in a matter of a few seconds, you get an answer from someone else. And that community knowledge has been very powerful. And this is something that is always in all other fields too. Like people who are in the recording podcasts in a studio, sound engineers, they have their own online forum, and they go ask questions and people come and respond to them, even though they're all competitors with each other, but they're helping each other. There is a power in this people's union, essentially, when they're coming together. So that turned out to be a forum, online forum for traders, and over the years we just grown and expanded our work and contents that we're creating for traders. So we are not essentially an academy or education website. We are a community, but there's a lot of powerful education in there through the community.
That's absolutely brilliant. The way you talk about community knowledge, that is something that seems to be spreading out through the sort of financial community, and the fact that you have it connected to your own company and website, I think it's great, and definitely applaud it. We could probably talk to you about a million different things today, to be honest, Andrew. But the thing that we really wanted to concentrate and maybe learn some more was about earning releases. Could you tell us what are earning releases, and what information can you actually gather from them?
Yeah, so public companies are required to release their earnings every quarter. So essentially 4 times a year, every 3 months, they have to release the information to the public people, because their shares are being traded by the public people. And in these earning releases, they're going to talk about how much sales they had, a lot of accounting information, what's their revenue, what was their cost, salaries, their profit or loss that they had in that quarter. And there's a lot of information coming out for the general public, and the general public can make a decision if they want to invest in this company or they don't want to invest in that company anymore. So earning releases are very, very important for investors and for traders as well, because they provide a lot of trading opportunities. For example, like today, we had AMD, which is a semiconductor producer, like they produces these chips and processors, and the earning was good. They beat the expectations of the Wall Street, and the stock was gapping up 7%. And this gap up 7% provided a lot of opportunities for us as traders or active day traders. Investors are also looking at it, because the people who were investing in AMD, and now there's an opportunity if they want to invest more, or they want to take the profit and come out of this company. So they're essentially events that happens 4 times a year for all public companies. Everyone, all of them has to do that. Like I know we are recording this one in February 1st. I think tomorrow the big companies, the tech companies like Apple, Amazon, Google, Alphabet, they're all reporting their earnings, and these are the big companies of the world, and everybody's excited to see how was their performance. But the most important part is if they surprise or disappoint the analyst, the stock can gap up or gap down, essentially, and that provides a lot of trading opportunities for people who want to take benefit from the volatility.
Yeah, that really does make sense. I mean, as you say, everybody should be sort of paying attention who's interested in trading on company stock. And I guess this is the thing I wanted to talk to you about, is your preparation. How do you begin to prepare for earnings season and sort of figure out which stocks you want to trade?
It really depends on the style of trading for the people. I personally don't really look at the fundamentals of the company, like how much is going to report for revenue or loss or profit. What I do look as an active day trader that I want to profit from the volatility in that day, I look at the price when the market in the pre-market opens. When the market opens up, gap up, or gap down significantly. If it's not significant, that means that the earning wasn't really something special, nobody got surprised or disappointed, then the stock is probably trading the same the price that traded yesterday, then we really ignore those earnings. But if there's a surprise, the gap up or gap down, Then I look at the price in the pre-market before the market opens, because the activity starts really before the official market opens. And that activity tells us about the strength or the weakness of the price. If the people are generally want to get out of the position that they had, or they want to take new positions and enter the market. So by looking at that, we plan for the market open. I personally do not trade in the pre-market. And if the market opens, and we see a really demand for the company, we could take it to the long position. We take it, we go long, and if we see that the stock is weak and we're losing the value, we go short or selling it short, and we try to scalp it through this volatility at the first half an hour or 1 hour of the market. So to answer your question clearly, we look at the pre-market price action. If it's gap up or gap down, does it have a lot of volume or no? Because volume shows interest, if there's a lot of interest from the market on that. And essentially looking at it if it's a strong or if it's weak in the pre-market.
And do you have somewhere that you go in order to source credible information? Do you have some key sources that maybe you could recommend for our listeners to look at related to earning releases, maybe company info?
Yeah, there is a website called tradingterminal.com that I think is a very comprehensive source of information for all of the information that a trader might need. The earning calendar is there, the expectations are there, the fundamentals are there, the analyst recommendations are there. They have even the simulator if you want to trade on a simulator and see if how would you do in the simulation. Plus the breaking news. And obviously the summary of all of the news that are coming, because as you mentioned, it could be difficult to find credible information just all across the Google. There's so many information out there. Mm-hmm. This is a website that I use and I trust, tradingterminal.com. There are other, this one is actually free, but there are sources like Bloomberg Terminal that they're used by professional traders in Wall Street, but that's very expensive, like $20,000 subscription fee for a year. So normal people usually don't want to spend that money.
Yeah, no, that's great information to know about. And the fact they have a simulator there seems like a really handy tool for people who are just getting started. Is that something that you'd recommend for people to do before sort of jumping in? Is it something that you've done in the past?
Simulator?
Yeah.
Oh, 100%. Yeah. That's, I think, the most important thing that the new traders should do is to trade in a simulator. So with the money that we call paper money, or something that really just doesn't exist, but you have to practice your strategies, because the game seems really easy when you look at the charts in the past. Oh, this one I buy down here and I sell up here. It's so easy. It's very easy, but you look at the chart in the past, everything is easy on the past. Mm-hmm. But when you're actually trading in real time, it's very important to know, first of all, you have a strategy, risk management, or, everything is awesome when it's working, but even if it doesn't work, what happens? Are you ready to get stopped out and manage your position? That's one thing. Plus the psychology is important. You have to have that confidence in your trading and skills, and that skill comes with the simulator. And it's like any other career, like pilots. If they want to become a pilot, they have to have hours and hours and hours mm-hmm. on the simulator to go through the simulation, different conditions and practice. And it's still, after they go and they want to fly, for example, a real airplane, they go first of all as the side, and then it's very stressful to slowly go up. It's any other career, they're using the simulation, and the trading is exactly the same thing. But the problem with trading is so easy to open an account and start trade. You just open an account, deposit the money, start. And that ease of access to the market is a little bit dangerous, because people, should understand that this is a very, very dangerous game. And, nothing would stop you from losing all of your money. There's nothing. So it's you that you have to stop yourself from self-destruction. Like, for example, in driving, if you make a mistake, the other driver try to avoid the accident, because it's costly for both of you, even if it's not their fault. But in trading, there's no one else sitting next to you and to support you. It's you that you go tap, 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 and you can just go all the way down to zero to self-destruction. Or other careers, like for example, if you're an engineer, you make a mistake, there's usually a team, and then there's a manager, there's someone to check the mistakes. But in trading, there's no one to check your mistakes, and you have to check your mistakes. It's a very high performance field, and you got to really consider that. So highly recommended a simulation, at least for 3 months.
At least for 3 months, yeah. I think that's the thing, and then unfortunately, people end up sort of learning the hard way, don't they? And then it's a bit of a sorry story. Yeah. I guess the other question. I mean, talking about the earning release, obviously these earning reports come out with the companies every quarter. Is a lot of the information that they're putting out absolutely valid in terms of their approach? Because I imagine they want to put themselves in the best light, and they're kind of trying to hide how well they're doing. Is it a case of trying to read between the lines sometimes with the information that you're given?
This is a good question. Reading earning statements are very, very tricky, and you have to be only a professional to understand what are the companies are trying to say, and what's the real truth about their earnings. Because there is a lot of different accounting practices and sometimes malpractices to hide a lot of information or report differently some information that is very important. And that's a big topic that a lot of companies are slowly moving to malpractice in accounting. So they report in a way that you think it's profitable, but it's actually not profitable just because they are categorizing it differently or trying to report it in a different format. So if someone, an ordinary trader, which I assume probably a lot of your audience are normal and not professional Wall Street traders, you have to be very careful reading through those lines. And it's something looks really good, but in reality may not be. I personally do not go through these deep reading of statements and try to make a decision from this fundamental analysis, because it's not my style of trading and investing. I am not a fundamental trader or fundamental investor on individual stocks. I just look at the price action, the price. The price tells me the truth. Doesn't matter what you read on those statements. As a trader, the market is always right. You have to see if the market, you might see, oh, this is an amazing company. Look at this profit. Look at this growth. And the market, doesn't believe that. The trades significantly lower, gap down. You shouldn't fight with that. You shouldn't say, oh, this is a good company. I believe in it. And even though it gap down 20%, I'm going to buy. So there might be something that you're missing. And again, as I mentioned, because it's extremely difficult to read that. And, market sees companies differently from normal people. A market is always forward-looking, future-looking. Like, for example, if the companies are really good, but their future is a little bit gloomy, the market doesn't like that. It might trade significantly lower. You look at the statements and everything is amazing, but you don't understand why the market is gapping down 20%, because the Wall Street or the financial market believe that this company doesn't have a future in 2 years or in 6 months. That's why it's trading lower. So, what we say is you always have to look at everything that you have available, but the market is always right, and the price action is the one that says the final word.
In terms of when you actually, what determines you to actually follow through with a trade? Is there something that has to happen for you to go, right, I'm going to go with it and go with your sort of gut instinct? Or the other way around, is there something that has to happen for you not to go ahead with something and be put off by it?
Yeah, so depending on the strategy of the people, they have to have this clear trade identification criteria. So that's your question, is what's your identification? Like, what's the criteria that you're looking at to go or to not go? For me, it's based on the chart patterns on the chart, on the candlesticks. So I look at the candlesticks pattern, and when I see a certain pattern, and if I get confirmation with the volume and maybe some of the statistical indicators that I have, like moving averages on my chart or volume weighted average price, I take that trade and manage my trade based on that. And there are certain patterns that are extremely avoid them. Like, if I knew, for example, a stock is selling off in certain patterns, this is a stock that I do not want to touch. Other people can have different criteria. Some people don't look at the candlesticks. They look only on some mathematical indicators. like a relative strength index or some sort of a moving averages combination, and that's all fine. All of them are correct. There is no one way of trading. There's millions, like essentially billions way of correct trading. Every person has their own way of trading, and all of them can be correct. For me, I look at the candlesticks patterns, if there is a certain pattern, and some indicators that I use, very limited indicators like moving averages and volume weighted average price. Those are the ones that I use.
And would you say that trading earning releases is in any way different to trading anything else?
Yeah, 100%. Trading normal stocks in a normal day can be very, very difficult because they're all impacted with the overall algorithmic trading of the market. Look, if I want to randomly trade a company like, I don't know, you guys are in UK, like Barclays, the bank. If I want to trade it on a normal day, that company is probably trading just with the overall London's market exchange. So whatever the market is doing, probably going there, because most of it is algorithmic trading. So it's very difficult. It's not impossible, but it's difficult because you're essentially having a very narrow range and a lot of computers trading it. And the earnings are the time that the volatility increases a lot, and the algos don't work as powerful as the normal days. And those are really the pocket of volatility. Because as a trader, you want the movement. You don't want something that doesn't move 1 cent or 2 cents. You want something that moves $2, $3, $5, and that volatility is the opportunity to the profit. So that's exactly what we do. We as a traders, every single morning we go through the scanners at tradingterminal.com, as I mentioned, looking around and try to find the earnings that give us this opportunity for trading and with volatility, and trade only those ones. And they are usually completely different from the overall market. The market might be very normal and flat, but those companies are going up and down significantly. That's what we want.
Yeah, so it seems like there is a bit of a special skill in order to, deal with looking at earning releases rather than just general day trading. And then combining those in is a little bit, it's a difficult game to sort of grasp. Would you recommend newcomers to start with earning releases, or do you think this is something that they should progress to later on?
No, I think they can start. I think it's a good place to start. Definitely on a simulator. That's going back to the previous point. They should trade earnings in the simulator because they should see how a volatile market looks like. They should see that volatility to, first of all, learn from it. Second of all, get excited from it, because that's where you make the money. So when the volatility is high, you can see a lot of profit can be made. Also, a lot of losses can be made. So that's why it has to be in a simulator. But I do highly recommend to try it out at the beginning, yes.
Do you have to hold on to your excitement a little bit, don't you, when it's going up and it's like a bit like, well, should I put all my money in there? What do you recommend for people who get on the verge of getting a bit overexcited, and what would you recommend them do?
I think having a certain rules on your strategy, or something that we call it the trade book, helps a lot. If you have a very clear criteria for when to enter the trade, when to take the profit, and when to get out, that helps a lot to remove the pressure of psychology. You can never get rid of the psychology. This is a high performing field. You're always under pressure and stress and excitement and euphoria, but having a very clear rules and practicing on sticking to your rule can help a lot. So I think that's something important. Like, all of us know that we shouldn't drink a lot, we shouldn't eat heavy at night, or we should have a diet, and we have to practice on it. Not always we do that. Sometimes we cheat a little bit and stuff, but if we keep that control of self-control, even for example in our diet, we stay healthy. Same as trading. You can never really get rid of those, rush decisions and excitements and stuff. But if you practice, you can reach to a point that you become a consistently successful trader.
I did read somewhere as well, Andrew, that you like hiking volcanoes, and you're actually on a mission to hike the 7 highest volcanoes across the continent. Is that correct?
That is correct. Yes, I'm actually in a few months. I'm heading to Nepal to climb Everest. Uh, so, to actually go on top of Mount Everest.
I guess when you're doing that kind of activity, then day trading doesn't seem quite as well. It seems more like a walk in a park when you're hiking Mount Doom. Yeah, no, I think it's a great thing to do. I wonder if it maybe keeps you calmer in the day because you're doing some sort of adrenaline activities away from the normal day trading.
Yeah, it does. Actually, it helps a lot. So there's, I wrote an article on Forbes actually about the similarity that I see between climbing mountains and day trading or trading in general. There are some similarities on that. The number one is that both of them are activities that you have to take risk. Risk taking is something that is in both of them. Mountain climbers always take risks going, to places that are risky. But what they do is to be able to be a good climber is they manage the risk with the rope, with the partner, with all the safety things that they put in place to protect themselves. Same as traders, it's a risky activity. You can lose your money, but you do it anyways because you have good risk management in place, that you do not lose or blow up your account. So it's one similarity that they have. Another similarity that they have is they are process oriented. When you're climbing a big mountain, you have to be very patient and just look at the process of the climbing. You can't just look at the summit and I want to be on top of that because climbing Everest can be 2 months, and in that 2 months, you have to think about the process, every step, every camp that you go up. It's same as trading. Everybody eventually want to make money on trading, but you have to be very process oriented. If your goal is just to make that quick buck, then you're actually not become a good trader because then you forget about the process, step by step trade management. And at the end of the day, the third similarity that they have is the passion. Mountain climbers are passionate about the mountain. They love going into the mountain and those hard conditions. Same as traders. If you don't like trading, if you don't get excited by this concept of trading, then you're not going to make it. You have to have the passion. A lot of people come and try and say, yeah, it's not something that I want to do. I'd rather to go and do something else. And that's fine. That's perfect. Yeah, you found that this is not your passion. There's nothing wrong with it. From the first day that I started trading, I got excited about it, and I really, really wanted that. So I had this passion, like the mountains.
No, that's great. Yeah, no, I think it's a brilliant thing that you're doing as well with the hiking. I think it's, and as you talk about risk management and a connection with the way people are looking at whether it's hiking a mountain or hiking the stocks and both trying to see the peak eventually. I think it's a nice thing. Going back to the earning releases a little bit, would you be able to tell us an example of a successful trade with earning releases and one that's been not so successful as well?
Yeah, so I can talk about the earning that we did today on AMD, as I mentioned, is a company that produces like Intel. Probably some people heard Intel that they produce these chips and processors. Like AMD is the same company, so the earning was really good. The market gapped up about 5% in the morning, and it was trading very nicely and strong with a lot of volume in the pre-market open. At the open, we looked at it. I usually wait for about 1 to 5 minutes at the open. So there was a lot of volatility at the open because a lot of people either wanted to get out or they wanted to come into that position. After 5 minutes, we realized that it starts very, very strong, so it's a very bullish candlestick, and then we saw that this is going to stay strong for the day, so we essentially traded with the long for the breakout of the first 5 minute candlestick, and that turned out to be a very, very strong day. And during the day, by the time that I'm coming, it's 2 hours in the market, it still stayed strong, and it was a very profitable trade. Another bad trade that I had on the earning was a company called still calls Yelp. You probably know that, when you go review, or go to reviews and places, you see reviews in Yelp. This is a public company in the United States. So they had earnings, and their earnings was really bad. This is for a couple of years ago. And the company gapped down 20% from the previous day. So it was very, very bad drop. And I got this bias that, this is a bad company. It's going to go down. And after market open, I actually shorted the company. So I sold the position short. And I was wrong because Yelp suddenly started going back up and up and up and up. And I was just, unbelievably looking at the charts, and this one just keeps going up and keeps going up, keeps going up. And I tried to just add to my short, to make it better. But eventually I had to accept a very heavy loss on that because the company, even though gapped down, it turned out the market seems that kind of overreaction. So it slowly came back up and closed something about -5% or something. So sometimes in these earnings, you see some sort of a surprise as well. That market overreacts, like gap down 20%, but it's really not that bad. Slowly price comes back up. And I was stuck in one of those trades and I lost money. So, but the problem with that was I had this mental bias that, oh, this is a bad company, I'm going to short that. But in reality, the market tells you what they think, and you have to respect the market.
Yeah, no, that's a hell of a story and a good learning curve, isn't it? Yeah, as you say, your bias thoughts getting in the way, and advertisements and everything you're looking at on the internet, everyone's all influenced, and it's hard not to be, isn't it? Is there any particular stock that you like to trade more than others? Is there something you always go back to?
Yeah, and it changes time to time. Like right now, in the last year or so, last 6 months, Tesla has been an amazing company to trade. Just we love the price, the volatility, the volume that is getting, and it's amazing. Tesla is maybe in the future is not going to be like that. Hasn't been always like this. So, and it's not going to stay probably. Every time to time you see a sector or certain companies become very active and you love trading them because there's a lot of opportunity, and after that they might go up. Like 2 years ago, during the pandemic, there was a lot of work from home companies like Zoom, Platon, or vaccine companies like Pfizer, Moderna. So they were really, really active in volatility every single day. We love trading them. And after that, when the pandemic is over now, so it's just we slowly moved out of from that. So time to time, there are pockets and sectors of volatility come, and we love it. Right now, the tech companies like Tesla, AMD, Apple, Google, Amazon, so they're good to trade at volume and volatility. We love trading them.
For people who are really, really interested in trading on earning releases, is there anything else that you think would be really valuable for them to know?
I think the most important part is to remove the bias or your personal bias from trading. I know we've used a lot of product ourselves, like Netflix, people are using it, Amazon are using it, a lot of things that you're using it, but that personal bias shouldn't come into your trading. And this is one of the, as I mentioned, one of my early biggest losses was on Yelp because I just don't like the company. I didn't like the app, and when it gapped down on the earning, and I said, oh, it's a bad company, it's going to go up. But no, I was wrong. Your personal bias doesn't matter. The market is always correct. So when you're trading the earnings, you should be remembering that your personal opinion and how much you're liking or using or disliking the company doesn't matter. Earnings, trading, if you are really, for example, if you want to trade today and earning is tomorrow, you have to expect some sort of the volatility on that. So can be sometimes gambling, a lot of people, because you don't know exactly what happens. There are some expected moves that you can read on Trading Terminal or other sources, but you have to expect some sort of unknown volatility. So you have to be ready for that. Therefore, you should take a little bit less risk or be a little bit more conservative. Don't go all in like gambling that either works or it doesn't work. So because these are extreme events, and it's good if it works for you, but if it goes against you, it can be disastrous.
Yeah, I guess you always need to take into consideration the general market momentum and what's happening as well. And there's many considerations to take, whatever you're earning. For any sort of general advice from yourself as well, is there something else that you'd like to add that we haven't talked about today?
I think I would say that trading overall is a skill that takes a little bit of time to master. And a lot of people are asking me, okay, so I'm going to come and simulation and start trade. When am I going to become a successful trader? When is that? What's the timeline? And the answer to that is, you guys should know that the answer to that is never. You're never going to become a successful trader and that's it after that. you always have to be careful. You always have to improve. You always have to stick to your rules. Otherwise, that one day you can blow up everything and lose everything. It's like, when can you say I'm a healthy, fit person? Never. You always have to make sure that your diet is in check. You are exercising. And the moment that you just let it go and I just drink every night, and then you're losing that fitness. So it's the same thing as trading. You are one decision away from having a very, very bad day, very, very bad month or bad week. So it's a process. Have to look at it as a process. Every action, every day, it matters, and having that impact on you. And if you are really passionate, try it part-time. I see a lot of people are just quitting their jobs and they just want to be focused on. This is not something that if you put too much pressure and time on it, it's going to be better. This is something that you need time every couple of days, every couple of hours per day. So just be patient with it. I'm a big advocate of part-time trading. I do not recommend people to focus on full-time trading, because the psychological pressure of a full-time trading is very hard, because every single dollar that goes up and down, you start saying, I need to pay my bills and that kind of thing. I'm a very big advocate of having a career, having a business, and trade part-time for a couple of hours a day on the side. Make some money. Even if you make $500 a day, that's how much is that? That's like a $100,000 a year extra. Even $200 a day can pay your mortgage, your car, or something like that. That extra source of income that could be really, really beneficial for people. You don't need to be full-time sitting behind the computers all day, because there's not always trading opportunity.
This is some really valuable information, and I think it's been absolutely brilliant to talk to you today. We've got loads and loads of detail in relation to earning releases and just trading in general. Thanks so much for your time. I wish you the best of luck with your trading as well as your hiking on Everest, maybe even more so. It's been great to talk to you.
Thank you so much.
No problem. Good to talk to you.
I appreciate having me.
Thanks, Andrew. Bye-bye.
Goodbye.
Thank you to everybody who's been listening today. We certainly have a lot of valuable information from Andrew. And please remember to go to investro.com, where you can sign up for our newsletter to receive all the latest financial information straight to your email. You can find links to our social media on there as well. And if you want to subscribe to the podcast, you can so on Spotify, Google Podcasts, Apple Podcasts, and YouTube as well.